More than half of all crypto trades are fake. On most exchanges, it's closer to 3/4. This is not a conspiracy theory. This is a peer-reviewed finding published in one of the most respected academic journals in the world, replicated across 3 separate studies and confirmed by an FBI sting operation. The largest crypto exchange on Earth, Binance, the one that took your ID documents, ran their KYC checks, and told regulators it was protecting you, was classified by those researchers as operating outside regulatory oversight. More than half its reported volume, fabricated. CZ built that exchange. He pled guilty to federal money laundering charges in 23. He was pardoned in 2025. And the volume numbers his platform was reporting to the market, the academics had a name for them: fake. I'm going to show you 4 things today that the financial press is almost entirely ignored. First, how researchers actually proved the trades were fake, because the methodology is the story. Second, which exchanges are clean and which aren't, because the answer is going to surprise you. Third, why the exchanges that demanded your identity documents have a worse manipulation record than the ones where you're pseudonymous. Once you see that, you can't unsee it. And fourth, what the FBI did about it, what Morgan Stanley said about it in their own legal filings, and what that tells you about who this market was actually built for. Subscribe now. The channel is the one place connecting these dots from the academic literature into plain language. Let's go. Let's start with the scale, because the numbers are so large that your first instinct is going to be to dismiss them. In the first quarter of 2020 alone, researchers documented $4.5 trillion in fake crypto trades. Not suspicious, not questionable, fake. Fabricated volume on centralized exchanges designed to make those platforms look more active, more liquid, and more trustworthy than they actually were. $4.5 trillion in 1 quarter. To put that in context, the entire U.S. federal budget for 2020 was $4.7 trillion. The fake crypto trades in a single quarter were nearly dollar for dollar with everything the United States government spent in a year. Now, where does a number like that come from? And how do you actually prove a trade is fake? That's where this story gets interesting, because the methodology is not complicated. It's elegant. And once you understand it, you'll never look at exchange volume numbers the same way again. In 2023, 4 researchers, Lin William Song at Cornell, Shi Li at Newcastle University, Ku Tang and Yang Yang at Tsinghua, published a paper in Management Science, which is one of the top peer-reviewed journals in economics and finance. The paper is called Crypto Wash Trading. I'll link it in the description. They studied 29 exchanges, 3 regulated, 26 not. And they used 3 forensic tools that accountants and fraud investigators have used for decades in traditional finance. The first tool is called Benford's law. Here's the principle. In any naturally occurring data set, the number 1 appears as the first digit about 30% of the time. The number 2 appears about 17% of the time. The number 3 about 12%, and so on. In a predictable logarithmic curve. This pattern shows up in tax returns, in population data, in stock market transactions, in river lengths, in the lengths of rivers on other planets. It's a law of nature. Real human activity produces this distribution almost automatically. Fake data doesn't. When someone's programming a bot to generate fake trades, they don't replicate the natural distribution of leading digits. The pattern breaks. And on the unregulated exchanges in the study, it broke badly. The regulated exchanges, Coinbase, Gemini, Bitstamp, they all passed the Benford's law test cleanly. The unregulated ones failed it. The second tool is round number clustering. Real traders place orders at irregular sizes. You buy 0.347 Bitcoin or 1.83 ETH. You're responding to a price, a budget, a strategy. Wash traders running bots to inflate volume tend to use round numbers. Buy 1.0, sell 1.0, buy 100, sell 100. It's easier to program and easier to net out. The unregulated exchanges showed abnormal clustering at round numbers across Bitcoin, Ethereum, Litecoin, and XRP trades. The regulated exchanges showed normal irregular patterns. The third tool is power law tail distribution. In real financial markets, the distribution of trade sizes follows a specific statistical shape called a power law. Large trades are rare. Small trades are common. The relationship between them follows a predictable curve. When you fabricate trades, the curve breaks. The tails look wrong. On the unregulated exchanges, the tails looked very wrong. All three tests pointing in the same direction on the same exchanges across 4 different cryptocurrencies. The researchers concluded wash trading broadly exists on unregulated exchanges and is absent on regulated ones. The average fake volume across all unregulated exchanges? More than 70%. On top-tier unregulated exchanges, meaning the big-name ones, the ones with the most traffic and brand recognition, the ones people actually use, more than 50% fake. On lower-tier unregulated exchanges, more than 80% fake. And Binance, the largest crypto exchange in the world by reported volume, was classified as Tier 1 unregulated in this framework. This isn't a new problem. The academic paper trail goes back to 2017. Neil Gandel at Tel Aviv University, J.T. Hamrick and Tyler Moore at the University of Tulsa, and Tali Oberman published a paper called Price Manipulation in the Bitcoin Ecosystem. It's in the Journal of Monetary Economics. There's a link in the description. They had something the later researchers didn't. Actual leaked transaction records from Mt. Gox with real user IDs attached. What they find inside those records were 2 bots. The researchers named them Markus and Willy. These weren't hypothetical constructs or statistical inferences. They were identifiable accounts in the exchange's own database, acquiring Bitcoin without actually paying for it. Between February and November of 2013, Markus and Willy acquired approximately 600,000 Bitcoin, valued at that time at $188 million. And on the days those bots were active, the BTC-USD exchange rate rose by an average of 4%. On days without suspicious activity, the rate was flat or slightly negative. The researchers concluded that the suspicious trading activity likely caused the unprecedented spike in Bitcoin's price in late 2013, when it went from around $150 to more than $1,000 in 2 months. One actor, 2 bots, a 567% price movement. Now that was 2013. The exchange was Mt. Gox. Mt. Gox collapsed in 2014. Everyone agreed the problem died with it. But it didn't. The 2023 Cornell study established that wash trading was systemic. The 2017 Mt. Gox paper established that it moved prices. A third paper, published in November 2024 on Archive by a researcher named Hunter Ng, established something more disturbing. Wash traders are not random. They are strategic. Using the same Mt. Gox transaction data set, Ng found that wash trading intensifies specifically when legitimate trading volume is low and diminishes when real trading volume is high. Think about what that means. A wash trader doesn't operate at full throttle all the time. They watch the market. When real buyers and sellers are active, their fake trades are diluted, less impactful, so they pull back. When the market is quiet, when liquidity is thin and a relatively small number of trades can move a price, they push forward. They're timing their manipulation to the moments when it has maximum effect on price. This isn't automated noise. This is a deliberate strategy, and it has been running with increasing sophistication since at least 2011. Here is the finding that almost nobody in the financial press has reported. And I want you to stay with me on this one because it requires holding two ideas simultaneously. The exchanges with the cleanest trading records in the Cornell study are the ones where you trade pseudonymously. No ID, no KYC, transparent blockchain. Every trade publicly auditable on-chain. The exchanges with the dirtiest trading records are the ones that demanded your passport, ran your face through identity verification, filed compliance reports with regulators, and positioned themselves as the responsible actors in a lawless market. The blockchain's transparency, the same transparency that privacy advocates have criticized and regulators have tried to eliminate through KYC requirements, turns out to be the single most effective anti-manipulation tool in the entire ecosystem. Here's why. On a transparent blockchain-based DEX, every trade is a public record. Researchers at Columbia University published a paper in November 2025, also linked in the description, that used network analysis to detect wash trading on the Polymarket exchange. Their method worked because the trades were on-chain. They could see which wallets were trading with which other wallets. They identified clusters, closed networks of wallets that almost exclusively traded just with each other, rarely touching real market participants. Those clusters were the wash traders. The method worked because the data was public. Now, apply that same methodology to a centralized exchange like Binance. You can't. Because the order book is not on a public blockchain. It's on Binance's servers. Binance controls that data. Outside researchers get whatever Binance chooses to report. And what the Cornell researchers found using the statistical forensics of Benford's law and power law distributions rather than direct transaction access was that what Binance chose to report diverged dramatically from what natural trading patterns look like. The regulated exchanges in the Cornell study, Coinbase, Gemini, Bitstamp, Bitflyer, Itbit, all bit licensed by New York State, all showing clean trading patterns. But here's the number that puts that whole picture in context. As of mid-2022, those 5 regulated exchanges, the clean ones, accounted for less than 3% of the total spot market volume. Less than 3%. Which means that more than 97% of reported crypto trading volume was happening on exchanges that either failed the forensic tests or weren't studied at all. The KYC system didn't protect you. It protected the exchanges from scrutiny while they reported whatever volume numbers served their business interests. The transparency of the blockchain is a better anti-manipulation mechanism than KYC compliance. That's not an opinion. That's what the data shows. You know things are weird when there's an entire chapter about the FBI confirming something. In May 2024, the FBI did something it had never done before. It created a fake cryptocurrency company, issued a real token called NextFund AI, and listed it on real exchanges. Then it waited. Within weeks, 3 market trading firms, ZM Quant, CLS Global, and MyTrade, approached the FBI's fake company and offered to artificially inflate its trading volume. In October 2024, the DOJ charged 18 individuals and entities with wash trading, market manipulation, and conspiracy. One of the accused firms, in recorded conversations with undercover FBI agents, described their methodology in plain language. They ran algorithmic bots across multiple wallets. They bought and sold the same token back and forth to inflate reported volume. They did it specifically to make the token look active, to attract real retail investors, and to pump the price so early holders could exit. Then one of them said something that belongs in a textbook. When asked how they operated on Uniswap, one of the accused responded, and I'm quoting, "That's how we do market making on Uniswap." Not, "That's manipulation." Not, "That's illegal." Not, We've never tried this before. That's how we do market making. This is not a fringe practice. This is not a few bad actors at the margins. The FBI set a trap for wash traders and 18 firms walked into it within weeks. The trap worked because the behavior was routine. In 2026, Morgan Stanley launched a low-cost Bitcoin ETF. They marketed it to retail investors as a straightforward way to get Bitcoin exposure. In the legal filings for that same product, Morgan Stanley's lawyers listed the risks. One of those risks was market manipulation. Specifically, they cited wash trading, dominant position price manipulation, insider trading, stablecoin manipulation, and hacking. They noted that tools to detect and deter these practices, and I'm paraphrasing their language here, may not be available to or employed by digital asset platforms, or may not exist at all. Morgan Stanley knew the market their product tracked was manipulated. They said so in their own legal documents. Then they sold the product to retail investors anyway. This is the same Morgan Stanley that called Bitcoin potentially worthless in 2017. It is the same mechanism I documented in the token trap. Talk the asset down while publicly letting retail panic play out. Then launch the product once the infrastructure is in place and the regulatory language is written. The extraction happens in the gap between what they say and what they do. The book is at thetokentrap.com. It's on Amazon. There's a link in the description. Let me give you the forensic economist's conclusion, because this isn't just an academic exercise. If more than half the reported volume on the largest exchanges is fabricated, then every metric that you use that depends on volume is compromised. Volume-based momentum signals, compromised. Liquidity assessment based on reported order book depth, potentially fabricated. Price discovery on exchanges where the operator controls the order book and has financial incentives to inflate apparent activity, structurally unreliable. This doesn't mean Bitcoin's price is fake. Bitcoin's price is determined by real buyers and real sellers across many venues simultaneously, including regulated exchanges with clean records, OTC desks, ETF flows, and on-chain activity. The price has real demand behind it. What it means is that the signals you're using to time your entry, to assess whether a market is liquid, to determine whether a token has real trading interest, those signals are being generated in an environment where the people running the infrastructure have every incentive to lie to you and a documented history of doing exactly that. The self-custody argument, the argument for holding your own keys, for using on-chain venues where the transaction record is public, for not trusting reported volume numbers from centralized platforms that control their own data, is not just about security. It's about whether the information you're trading on is real. We went through a lot of information today. If you've stuck it out to this point, thank you. There are 4 papers behind everything I told you today. The links are in the description. Read them. The methodology sections especially. Benford's law, power law tail distributions, network cluster analysis, these are not complicated. They're a little complicated. They're the same tools forensic accountants use to catch fraud in traditional finance. The researchers applied them to crypto and found exactly what you'd expect to find in a market that has operated without meaningful oversight for 15 years. The question worth sitting with is this. The Cornell paper came out in 2023. The FBI sting was 2024. Morgan Stanley launched their ETF in 2026, citing manipulation risk in their own filing. At what point does "we didn't know" stop being a defense? I'm Dana Love, PhD. The Token Trap is at thetokentrap.com and on Amazon. If this analysis is useful to you, please subscribe. We're not done examining the mechanism. I'll see you in the next one.